Hello guys, welcome back to our value investing channel. Today, here we are again with Daniel Kotas. Hi Daniel, welcome back.
Hello. Nice to be back. Thank you for having me.
We spoke already with Daniel last time when Daniel just presented their analysis about MetLife. Was a really great investment for him. And Daniel asked me, we work together as a value investor team. And in fact, today we want to present you another company that we have discovered and studied that is a Checkpoint, I can already see. And now Daniel will show us his deep study on this company. We are going to present all the business of the company, data, so balance sheet, and then a possibility for investing and the intrinsic value of the company. So thanks Daniel in advance, because I can see that you have done a really great job, and now we are going to see it. And just 2 words really briefly if someone doesn't know you yet.
Yeah, thank you. So yeah, last time I think I did a poor introduction of myself. So together with Domenico, we're both certified value investors on the investment platform eToro. I'm actually wearing the shirt. I don't know whether you can see the logo, the Thoughtful Investor. Yeah, but they're super comfy. And except for that, I'm a master's student in banking and finance at the University of Zurich in Switzerland. So yeah, I'm always surrounded by banks and all that stuff. And moreover, I'm a member of a quite exclusive university program called Portfolio Management Program, where we manage €1.5 million as students, and we're specifically trained to become portfolio managers. So yeah, but value investing is my passion. I've been doing for quite some years now, and so that's about me. And I guess we can start with the presentation, right?
Absolutely. So we can start and see what kind of opportunity is there with Checkpoint.
Awesome. Okay, so the Checkpoint Software Technologies, I did the research, or I've been doing the research for a couple of weeks now, the last weeks, but I finished it on 25th, which was Thursday. Yeah, so it is quite fresh. And as Domenico said, it was a joint research. So he basically approached me and asked, like, look, there is this company and the financials look really solid, but the price like isn't moving, like sort of the market doesn't recognize the value in it, or like what is happening. So I started digging more. And yeah, that'll be the topic of today's equity research. Just very briefly about the company itself. It's a soft or cybersecurity company, which means they provide solution in, well, cybersecurity, so securing your computers, your LAN systems, etc. Here's a short overview of basically the generation of cyber attacks they're protecting from. So the latest generation is generation 5, and those are, like, everybody knows, like Trojan horse and those typical viruses. That's like the very basic stuff. Today, it's yeah, the generation 4 and 5. Those are very advanced, and unless you have IT background, you're not gonna really fully understand the threat. The thing is, they also claim they provide protection from 6th generation cyber attacks, which is kind of a bold statement because 6th generation doesn't really exist yet, but it's basically like nano cybersecurity attacks. So when the nano computers come in together with the technologies and the threats, that's what the company is already preparing for. And maybe people who are not really familiar with nanocomputers compared to today's computers, that's like modern day soldiers to medieval knights, right? There's like no comparing. Like the computational power of a nanocomputer is immeasurable, but it's just so much higher than standard computers. So if a nanocomputer would attack like a traditional system, and say a banking system which is running, or other, I don't know, maybe like some shopping site like Amazon, which is running on old school computers, it would absolutely obliterate it. So that's why it's very important to keep the cybersecurity in check. And that is what the company is trying to offer. So just a quick overview of the products. They have a really wide offering. So they have the quantum, which is the network itself, Internet of Things. That is very important thing because everything is getting more connected right now. So you have like your smartphone connected to computer, that is connected to the cloud, that is connected to the printer, and those are all potential entry points, and it's very important to secure that. And yeah, more devices means more revenue, of course. Then you have the cloud guard. Then you have like the Harmony. That's basically for the user's perspective, because from the hacking perspective, it's a well-known fact that the biggest threat to any system is human, because that's the easiest access point. And then they have the Infinity Vision, which is a very interesting part. It's a new product development and is an all-in-one solution, which for the business is of course amazing if you can offer all-in-one package. So they are constantly growing their offering, which of course in such a fast evolving market is very important. So this is just a brief competition and industry overview. So it is not the biggest company by revenue. The biggest one is Palo Alto, which is growing really fast. Other big players to consider McAfee, Norton, of course. They're more focused on the antivirus itself, but they, of course, have more offerings. But then there is the Fortinet and Trend Micro. So these four, so Palo Alto, Fortinet, Trend, and Checkpoint, are the like cybersecurity really firms with securing the, as I was saying, cloud, the networks of computers in companies, so business to business type of firm and such. So yeah, it is not the biggest one, but still, the industry itself, it's like obviously extremely fast evolving industry. So that is actually not very favorable, because that means for us as value investors that it is hard to predict, right? I mean, it is very hard to describe for me what 5th generation cyber attack is, let alone 6th generation, and we don't know what it will lead. So that is a little minus. On the other hand, if an industry is fast evolving, that means big opportunities, right? So if the company really spends a lot on R&D and comes up with a really good solution, that means, yeah, a lot of untapped market. The industry, I labeled it like no mistakes allowed. I mean, imagine you have a security firm, and it doesn't matter if it's cybersecurity or like personal, personal private guards or bodyguards. If you do one mistake, you're out of business. Like if you provide cyber solutions to Amazon and Amazon gets hacked, you're done, right? So it's very like you have no margin of error basically. And that's why you still need to be on your toes at the top of the game. That's very important. On the other hand, there are very high margins. Like companies, Amazon, Apple, or basically any company is willing to pay a sizable premium for such a product. And since it's a service, you don't have much overhead, you don't have much materials costs and stuff like that. So you have just very high margins, which is of course favorable, which you can then invest. And another thing is strong competition. Of course, it's a tech industry, and tech is growing like crazy. So the competition is strong, and we'll see how it goes. It's still relatively new compared to other industries, but we'll see.
But so in this light, we can say that Palo Alto, Fortinet, and Checkpoint are the 3 ones that has the best product right now.
It depends. Like if you look at the reviews and stuff like that, the Palo Alto and Checkpoint are definitely the 2 best in terms of the product itself, depending on different reviews, and Fortinet as well. So. Okay, just a really brief SWOT analysis, which will set a primer for valuation. So they are really pioneers in the industry. They were actually the first company to offer firewall commercially, and they have a very strong cash position, which we'll look at later. The weaknesses, they're considered like an old-timer a little, and yeah, it is questionable how much they'll be able to innovate, but I'll get to that later. And well, the threats and opportunities we already talked about in the industry overview. And I put conservative a little in the middle, because like conservative for the value investor, that is a good thing, but for the business, especially a tech business, being conservative might not be the best thing maybe. So I put it like in the middle, so to speak. So yeah, it's a double-edged sword, definitely. And I'll explain how they're conservative later. So let's talk about the management. I forgot to mention it's an Israeli-based company, which is important, which will become important now. Israel actually is very strong on research and security. I mean, Israel is basically constantly at war with somebody. So they really invest a lot in security, and for some reason it is a hub for tech firms in cybersecurity business. And so the management is very conservative and very value investor friendly, so to speak. So to give an example, in the last 4 years, they acquired like 4 major or big companies, and 3 of them were Israeli, they were local. And that might seem like, okay, why is it important? Well, it is important because if they're from Israel, if they're based in Israel, they understand the market well. They understand the companies. They understand the culture. Like for a business, the synergies and assimilation in a M&A situation, the assimilation is very important. If they focus on local companies, that means that they understand them well and they buy only companies they understand well. So that is extremely important point, actually. Then they introduced the Infinity solution, the Internet of Things solution, which I mentioned, that they kind of offer an all-in-one offering, which is the trend. So that I deem very good. The pink thing in the middle, that is the logo of the Infinity product. Then another important thing is that the insiders hold 21% of shares, which is I deem very important, and the CEO and founder hold 17%. So yeah, there you have like another guarantee that they will not spend and basically throw out the cash out of the window. So they're very sensitive with how they spend the money, because yeah, a lot of the money is by the founder himself. And last thing, Checkpoint has been somewhat paradoxically criticized for being conservative with cash. That is what I already mentioned. And if you read a lot of research, then yeah, Checkpoint is criticized that they're not acquiring companies, and it's right now in the market conditions we're living in a state that again, it's if maybe some people know or remember even the 2000 dot-com bubble, like companies were acquiring other internet companies like crazy and everything was growing, valuation, etc., and then it all crashed, and we're living in a very similar situation right now. And yeah, criticizing company for not growing and not being too aggressive seems somewhat weird to me, even though they're in tech industry where growth is everything. But still, I think I deem it actually good that they are conservative with cash. I deem it good that they are and they're relying on organic growth. Organic growth meaning they don't want to just acquire all the companies around and take their revenues and their clients. They just want to grow their business, like core business themselves. So I deem that very good. It's very conservative, and that's like a hybrid actually, like tech company which is managed like that. That's not very common, and that's why I think it's very interesting. Also for the valuation later. So let's get to numbers just very, very briefly. So that's about value creation. Put simply, if the line is above the bar, that means that the return on invested capital is higher than the price of the capital, and that means that value is created. You can see it like exceeds by a substantial margin. So that's actually really great. Then you have profitability ratios. So you can see ROE is the long-term average is around 20. So that's amazing. The ROA, so return on assets, is also very high, much higher than we require, which is around 6. Net margin is just, 42% net margin. How amazing is that, right? So
it was the parameter that catch my attention at the beginning.
Yeah, I mean that's just unbelievable how high margin that is. And yeah, that is reflected also in the cash. I mean, these the two high bars, which are there all the time, those are quick and current ratio. So put simply, they have a lot of cash, right? They just have a lot of cash. And you can see that they're like in the legend there are 4 things, but in the chart there are like only 2, one's free. That is because they have no debt. They have just no debt. They are financed completely by equity. And that is just flabbergasting to me how such a company, like tech company, like there are not many companies that can do this. Google does this. Google, for example, also has no debt, but Google is one of the biggest companies in the world. So this is simply amazing.
The best things on this company is that they generate a lot of cash. Is really a cash machine. And so they can do everything with their cash. So that's why they have no debt, and they can make an acquisition or, as you already say, buy back the shares.
Yeah, we'll get to that. So definitely. And so considering they have no debt, and just quickly jump back, they have like 20% ROE. That's outstanding, truly. So The valuation metrics, just quick ratio. So the PE, and this is amazing. Like we are talking like how the company financially, how good the company financially is, and now we see PE, and it's only around 20 something, the long-term average. And such companies have PEs like in hundreds even, right? Because they often are very low on earnings or are very overvalued. And this company seems pretty standard. So that's very good. Then you have the free cash flow to revenue. That is the uppermost line, and the free cash flow to revenue is around 50 to 55%, and the free cash flow to price is around 6%. So yeah, that's just very above our values we would like to see. So from the first point, it seems undervalued or at least moderately valued. Some growth rates, I'll not spend too much time here. They vary widely, but yeah, maybe important thing to notice the estimates for the 3 years growth, like average for every year by the analyst, by the consensus of the analyst is around 8%. So that is right here, the left bar. So that is good. Then here's the estimate free cash flow to growth is only 1.5%. I'll get to that, how I got the number. So this is based on like the best fit regression, and these like the full or not dotted line. These are the actual growth rates of the revenue in the upper plot and earnings in the lower plot. You can see they are very much correlated. I mean, of course. And then the dotted line is basically like the fitted line and the prediction. This is very mathematical, and it absolutely lacks any like fundamental qualitative assessment or judgment. So it might not be the best figure, but it gives you like a rough, ballpark number where the earnings could grow. And so this is the first hiccup I would see, that you can see definitely that just the growth of the company is slowing down, right? Regardless of how you look at it. And that will play a big part of the valuation. So yeah.
This is the main risk part. We can say that the bad part of the company is that the growth is not so high. We are speaking around something from 5% to 7%, something like that. So the trend, the growth trend is not really high.
Yeah, exactly. I mean, if you look at, for example, Palo Alto or other competitors, they're really aggressive on acquisition. And what an acquisition does, it does two things, or basically three things. The main point of an acquisition is, of course, to buy a company and then take its revenues and take its clients, so you are bigger. I mean, that's good. What is not good, that you have to finance the acquisition somehow, and acquisitions are typically very costly. That means you either have to sell a lot of shares, which dilutes the shareholder value, or you have to get a lot of debt, or both. And it's bad. Like, all for a value investor, all are bad unless you are compensated with very high earnings in the future. Which there are some academic papers which see that in a lot of cases, I mean, in vast majority of the cases, value is actually destroyed in such like leveraged acquisitions. So yeah, not very good. But what it does, for example, for Palo Alto or these aggressive growing companies, when they buy, for example, they buy a company, and suddenly they can report in financial statements the revenues of the new company. So for example, let's say the revenues of Palo Alto are 10 billion, and then they buy a company or company which produces 5 billion of revenues. Well, in the next year, they have 15 billion of revenues, and revenue growth is 50%, right? So it looks very good, but it's very artificial. It's not organic. And Checkpoint is very organic growing company. So you have to account for that as well. Okay, so some pros and cons for the valuation and for setting the discount and growth rate. So the pros, it's bulletproof. Like, financially speaking, the company is simply bulletproof, and is returning and creating value steadily. So I'll get back to the returning value in a second. Then you have the aligned incentives that, like, for value investor, that is extremely important. Some would claim even the most important thing. So that's good. It appears quite undervalued. We'll see about that, how well it holds. And then there are massive share buybacks. So that is actually the returning value part, and I'll show you in a graph in a minute. And then there are cons that might not keep up with the competition, depending on yeah, we'll talk about it in a minute also. But the point is, the competition is growing very artificially, very aggressively. Nonetheless, it might put chip out sizable chunk of the business of Checkpoint. And yeah, it is unclear about how they plan to beat the competition. And this is a point I would like to stop for a minute. So when we were researching the company with Domenico, it's like neither I and Domenico has engineering background, but it's still not IT background, and we were trying to understand the company and its products really well. And we were, of course, trying to get a sense how the company will beat or be better than the competition. And I was actually messaging a lot of employees on LinkedIn, both from Palo Alto and both from Checkpoint. And yeah, the employees are very, they just didn't want to speak with me at all, even though I was very clear, like, look, I'm doing an equity research and I'm just interested how your products are better. That was it. Like, I was just, even a consumer can ask that question. Like, if I'm a business, I want to know, like, why should I choose you, right? And the companies were very secret. The employees were very secretive, and they were like, "No, I cannot answer that question," and very secretive. And I mean, I understand it's a very competitive and industry, and they have for sure a lot of what you call commercial or company spies. Like people who really spy on other companies and stuff like that. But yeah, I really didn't get an answer, even though I messaged a lot of employees. I didn't get an answer like how is Checkpoint better, and why should the businesses and the customers keep choosing Checkpoint in the future over the competition. And I didn't get an answer, so that's why I put it's not clear. And all in all, the situation was very weird. But yeah, and again, I put a conservative in the middle. It's like more of a prawn, but can be also a little calm. So yeah, let's look at the valuation. So it might seem very complicated, but I basically dissect the growth rate into two parts: the 3-year growth rate, that's based on the analyst estimate, and then the growth rate from year 3 to 10, that's based on the mathematical model. That's very conservative and it lacks any qualitative assessment, but it's rather I would rather be conservative. So then the average, the base year cash flow, I always take the 4-year average to kind of smooth out any outliers or any unstable cash flows. Then the long-term growth rate is, I always set to 3% is the conservative way. And I set the discount rate to 8%. 8% because financially the company is bulletproof, but I added an extra, so that my base is 7%, but I added 1% extra, like the business risk premium, so to speak. And based on such a valuation, you get minus 16% undervalued, or overvaluation basically. So based on such valuation, it's overvalued. Long story short, this is the typical company what Warren Buffett speaks about, when the best or ideal scenario is when two people value a company, they should never reach any concrete conclusion, that the valuations should be with such a wide margin that no conclusion can be reached. This is what he says. And what he means by that valuation is not just, putting numbers in the calculator, like everybody can do that. The beauty and the art of value investing is actually assessing the business and how much you think the business will thrive. And this is exactly the type of company. What I'm trying to say by that, at the end of the day, it's financially secure, so that is good. And the success of the company, and thus also the investment, will depend purely on how good the company will perform in the future as a business, right? And there is, you can make some predictions, you can make some estimates. I mean, the products are very good. On the other hand, it is not growing that much. I cannot forecast it. So that's why the valuation is a little complicated and opaque. You cannot really see into that. And also, in the appendix of this presentation, you can check out the presentation on my blog. If you put, for example, 7% as a discount rate, you suddenly get undervaluation of 15%, right? Or if you put a higher short-term growth, I put 1.5%, that's extremely low. But if you put 4 or 5%, suddenly you get much higher valuation. So the company can be as much undervalued as you want. It really just depends how much the company will be simply able to provide for the investors in the future. I personally think it will be stable, but we'll see about that. But another part is like Domenico asked me and approached me, like, if you look at the price chart, which is the blue line, in the last 3 years, the price didn't do basically anything, right? There's a little drop here, a little upswing here, but it's basically the same as 3 years before. And Domenico's question was like, how is this possible? How such a financially stable company can not grow like in price? And the question is, the answer is they're returning value in share buybacks. They're really very aggressive on share buybacks, and they're spending a lot of cash flow on it. And you can see that in the graphs. So that's number and value of shares repurchased. That is an absolute number, so it doesn't tell you much. But in value return, if you put it in relation to price, then value return is the blue line. That's in percent in relation to price. So that's basically your return, even though you don't see it in your account. It means there are fewer shares, so your stake is larger, right? So if somebody maybe is not familiar with how share buybacks return value, you can just quickly look it up. But basically, you buy a piece of cake, but then suddenly the cake keeps getting smaller, but your piece is stable. That means you suddenly have more of that cake, and that is how the value is returned. And as I'm saying, you can see it in the line here. And in percentage terms, you get like 7% on average every year for the last 8 years. So that is very good, and that is disregarding the price appreciation or depreciation. So this is how the company actually returns value. This is how you make money on the company. And also there is the PE, I call it PE row evaluation, and that is a valuation based on growth of the book value. And because the company is buying back its shares, the book value per share keeps growing like quite a lot, and they have a very high ROE. And combined with that, it predicts or forecasts like 25 expected return per annum. That is a very high valuation, and I don't think that's real. The point is, you can just see how two different models predict or show completely different values and completely different valuation. One tells you like, yeah, the company is a little overvalued. One shows you like this one, that the company is super undervalued. And I think the truth is somewhere in the middle, right? So the company is a cash cow, no doubt about it. And yeah, as I was saying, and as we were talking about before the recording with Domenico, the success of the investment depends really on how the business will perform. If the business, and this is my like final statement on the valuation, if the business will be at least as good as it was until now, I think the investment should work. I think it should return very stable, like 8 to 10% a year, which I think is quite good. And anything extra is of course favorable. If the company suddenly starts growing very fast and overtaking the competition, then the return will be stellar. But I don't think that will be the case. But I don't think either that the case will be that the company should fail or go bankrupt or out of business. The company has spends a lot of revenues on research and development. It has big customers: Apple, Amazon, Google. They started new product line, the Infinity. So I think the business will evolve, will get better, and that's why I'll get back to it later. That's why I decided to like buy the company, but very moderately, like less than 5% of the portfolio, and just put out a feeler, just see what the company does, what the investment does, because I just think the company is really stable. So I will buy it for a year, see what it does, and revisit the valuation, see how the business has evolved, and then decide what to do next. But I think it's worthy to test the company out for a year. And my last slide is just comparable company analysis. So you can just see that compared to either the median, so it's right here, or the other companies in the industry, it's quite undervalued, maybe with the exception of Norton, which is more or less the same. But Fortinet and Palo Alto are just massive, or not overvalued, but the valuations are quite high. Palo Alto doesn't even have PE ratio because they don't have any earnings, obviously. So they're super aggressive growers. But yeah, so this is my take on the company.
We can say finally that they have a really great product that with Palo Alto for Fortinet are the best one. They are really a cash cow, so they make a lot of money. But we don't know yet why they don't spend some of those money with marketing, for example, to have a much higher growing business. So the growth is the best topic to understand. And if it's still like this, it's quite low. But if they can improve the marketing side, maybe, so and the growth could be better, and then you have a really great investment. So
definitely.
There is not a short answer, but we need to understand and check how the management of the company will face with these kind of things.
Yeah, definitely. I mean, the marketing part, actually, one employee messaged me back. The person was very kind, but gave very vague answers because the person was not precisely, I don't remember the department, but they were not from the product department, so they really couldn't answer the question how they will be better. But I was giving some question like, what about marketing? Like, do they invest a lot? And somewhat jokingly, the person said like, no, marketing is definitely not strong suit of the company. And you can see it maybe even in the logo. I think the logo is just really, old-fashioned, very funny. But on the other hand, like, it's a B2B company. I mean, they have some retail solutions as well, but it's mainly B2B company, and marketing is not the biggest player there. It's more about that their products are being sticky, which is good. Mainly the Infinity product line, which means that it's like the all-in-one solution. And yeah, for big businesses, it's just very I'm sorry, I forgot a word in English, but just very strenuous to switch, because if all systems are integrated with their solution, just switching is too costly and too time consuming. So
absolutely.
Again, as you said, there's no easy answer, and I think this is what valuation and value investing should be like. There should be no easy answer.
Take everything in consideration, and then anyone can understand if this kind of company fits their portfolio or not, according to the risk and everything.
Totally.
I think that you give us a really a good explanation of everything that could be pros and cons on this company. And I can see that you have done a really lot of work. So really thanks, Daniel.
My pleasure. Thank you.
I want to remind you that you can find just above the link with the playlist with all fundamental analysis we do every time with all different company, while just below in the description you will find the slides that Daniel just show us, and our public portfolio, because me and Daniel both are value investor, but even popular investor on the eToro platform. So we have a public portfolio that you can even copy if you wish. So thanks again for watching this video, and see you in the next value investing analysis.
Thank you very much. See you next time.